ETFs are officially Australia's new favourite investment. And so tonight we show you how easy ETF trading can be with glimpses from our government-accredited share trading education and give you 10 ASX ETFs that are looking primed for massive moves next. With insights that has our experts regularly called upon by major media Australia-wide, I am Philip Tortevsky, joined by senior analyst Janine Cox and Blueberry Market Zoran Krezovic. And we are Wealth Within. Good evening, team.
Good evening. This one's a bit controversial, isn't it?
Well, I thought, there's been a lot of news going on around ETFs. They are booming at the moment, so why not address it and put our little spin on it? Zoran, how you going, mate?
Good to be here.
Yeah, I know you had a nice holiday away, so I'm sure everyone's going to be happy that you're back, but let's get right in now. Check this out, this article that came out yesterday showing Australia's ETF boom is breaking records with 72 new ETFs launched this financial year, more than 50 billion flowing into the sector and over 458 exchange-traded products now listed, set to top 500 within the next year. And so I want to ask, with all this excitement and new products hitting the market, what should new investors or traders looking to get into the ETFs be focused on mostly, Janine? Because, I mean, it's going to explode. More people are coming into the market. This is their first stop instead of stocks. What are some of the things they need to focus on?
First of all, strategy. So what are they aiming for is the real question. And, are you wanting to have a sector-driven portfolio and you're focusing on ETFs that will address those criteria? Or is it that you're wanting to look to capture just the broader market? Are you wanting to capture individual specific areas? So like the tech was one, really the trends, and really be up with all of that. So that's one first thing, is to be really clear about that. The second thing, and it doesn't matter what investment you're looking at, don't let anybody tell you any different, that you need to have a strategy for managing the risk on that. And a good place to start is to look at the trends and to really understand, one, how the trends form, and two, because that'll tell you whether they're going to continue. And ultimately, that's what you really want, to know that you're going to be making a profit out of it and not getting in it right at the top. And if you do, then how are you going to protect your risk in that case? So it's all about making sure that you've got a simple technique, something really easy that you can apply to any chart, any time frame, and really make sure that you're protecting your funds.
Yeah, we're going to show you some of those techniques, so sit tight. There are some special ones in there, and I'm also going to show you where you can find those in a second. But I want to move on now. Are there certain of these techniques that stand out when approaching the ETF market that could be different to stocks, for example, especially as we are now in a strong period of momentum with this asset class? Zoran, I'm going to ask you, because it is important. Oftentimes I find traders can get stuck in moving between markets and trying to, do exactly the same thing, where markets are in different phases, different things are happening. Yeah. Right now, ETFs, there's huge momentum. Yeah. Are there certain things that can help traders in terms of time frame techniques that they can use?
I mean, different markets cater for different strategies, right? But I think in the current market, in a super bullish market, or super bullish cycle, what we're seeing on the ASX and also in the US equities as well, probably momentum line or trend lines can help a lot as well. So I think that's one strategy that has been actually working really well, especially if things are going quite parabolic. You want to actually capture the most of that momentum in your favor, but you also want to make sure you have a solid strategy when you're exiting out as well. So that's probably one that comes to my mind as well. Pattern breakouts are another one, which is really good, but when the strong momentum is actually flourishing and ETFs or stocks are going, creating high highs and higher lows, then it can be maybe a little bit challenging to actually go through the pattern breakouts, because obviously pattern breakouts consolidate for a long period of time, and they can actually take time to actually eventuate and to mature as well.
What about things like time frame? Because I know, a lot of people are into short-term trading, but when you look at the ETF landscape, you look at the way these products are structured, the volatility is subdued compared to stocks to a large degree. Is the short-term the right approach? Is it very long-term? Is it be active? Yeah. Where do you sit in all this?
If I'm talking from a client's or trader's perspective, I dare to say that ETFs are more catered probably for medium to long term. I would generally say that, because the product managers or the fund managers that are constructing those ETFs, they tend to actually focus on probably lower volatility and like just more of a like an income side of things. But at the same time, there's no right and wrong. Like if you're a trader that's equipped with good knowledge and understanding of the market, then you can trade that on a shorter term basis as well. But I dare to say the ETFs are probably more so, created for more of a medium to longer term horizon. But there's no right or wrong though.
Yeah, and I mean, if you do want to learn some of the techniques, like Zoran said, the trend line, go and check this book out. It is How to Beat the Managed Funds by 20%. It is free, you just have to pay the shipping. It's from Dale Gillen. The link is in the description in this video. But if you do want to take things professionally, please go and visit the website. Go and look at our diploma of share trading and investment. It is government accredited. You will not find that anywhere else. And please go and look at the testimonials to see what is achievable. But I want to get into some ETFs now and have a good look. And as we do, I think it'd be nice if we show some of these techniques. I mean, don't go into too much detail, but show a little bit about what's possible when you have some structure in your trading, because I think it can help a lot of people, just having a little bit of structure, what's in this book, to see what's possible, let alone if they do want to take their trading seriously. I mean, that's a whole nother conversation.
I mean, like you said, people are going into these to avoid volatility, and they're not going to be exempt from any volatility. They will, depending on what type of area their focus is. So the first one is BetaShares Global Cash Flow Kings ETF. Now, this one invests in 200 global companies with strong and consistent free cash flow and relatively low debt, aiming to identify financially robust businesses. I mean, this is all fantastic to look for these sort of ETFs, but it doesn't mean that you're protected in a crunch, because as we know, all shares, big banks, even the most liquid stocks and well-positioned stocks still fell significantly during that sort of crunch. So that's what we're talking about, preparing yourself for, even if you want to be in these medium to long term. And here we've just got a simple monthly chart, and we're just following the angle of that trend up. While the stock is just bouncing along that line, it's fine. But if it changes and there's a significant shift in the direction of the stock, you're going to see it with these lines, which it's illustrated in the book how you can use these. And I remember when this was years ago, I was in the office one day and someone came to see Dale and he thanked Dale. He just wanted to come and shake his hand and thank him for writing that book, because it actually saved him a lot of money when the GFC, then the crunch came, because he used the simple trend line to exit his position and then be waiting for the next opportunity when it eventually came after the low, whereas a lot of people were just sitting there riding that whole crunch down.
It's so important, because I mean, and I want to get your thoughts on this as well. We were talking about it even in one of our latest market reports, just hypothesizing the idea, are we living in the most manipulated markets in the world right now? And what can you do about it, right? We've seen tweets, posts, I would dare say shonky type trades going on around the world. But nevertheless, when you break it down and you say, okay, how does it affect me as an individual trader? How do I still get something out of this situation? Well, regardless of what's happening around the world, price is price. It doesn't change. Yeah. If somebody's buying or selling, you can see that. It's not hidden. And so where should you be placing your focus as a trader? For me, that price, you avoid all this stuff going on with manipulation. And if you're not so zoomed in, watching or trying to trade every 5 minutes, then you can see things unfold and be on the front end, like we've shown time and time again on this show. But
we'll both say the same things with perhaps slightly different words. I mean, it's all about what you can control, and being able to control something. And it's about controlling your risk is really the important thing, and where you're going to buy and when you're going to sell. That's really it, isn't it? Yeah,
fantastic. All right, Zoran, next ETF.
Sure. The next ETF that we have is VanEck Global Clean Energy ETF. So investing around 30 of the world's largest clean energy companies, including businesses involved in renewable power generation, clean energy technology and equipment. And this one has been going through the roof, as we can tell, ever since the actual lows in April 2025. And that was an interesting point in time because that's when the market bottomed out with all the tariffs that were implemented by US President Donald Trump. And ever since, obviously, never looked back. Energy sector has been obviously performing quite well, despite the recent actual pullback. But this is what you guys mentioned just previously. Having a trend line or momentum line that protects the trend will actually, whilst many might actually start panicking when they see this 10-15% drop and number of red and outside blue bars, as a trader that's got quite a bit of knowledge and experience and tools to protect themselves and good rules, this is not going to concern them at all, if that makes sense.
Oh, for sure.
Because what we've been taught within the course of diploma, this would be just considered probably as a generous pullback, but the uptrend line would still probably most likely be in full play. So, I think the good aspect of the trading course or the tools that we learned in there is actually it's more like red flags and it gives you like traffic lights, green, yellow, red, and you just basically manage yourself as opposed to the external environment, which is what we discussed previously. Irrelevant of the noise, what Donald Trump is actually posting on his tweets or whether he's actually implementing whole heap of restrictive measures or monetary policy or anything that's going to influence the financial markets, it's actually you controlling yourself and having a set of rules that are going to protect you. And if you stick to that, then it's irrelevant what's happening outside.
Yeah, I think to summarise it, you're talking about trading with confirmation and
as opposed to speculation.
Yeah, and discipline and everything else follow
That's
from
right.
that, which is a very wise point there from Zoran. Let's move on to our next ETF, Janine. What have you got?
All right, the next one we've got invests in Chinese companies driving the country's new economy, including technology, healthcare, consumer communications, and advanced manufacturing businesses. Now, this one's actually been on a really nice run. I'm just going to focus on that monthly chart for you for a minute. But we can see that we're just looking at for the angle of a trend, and we can see that the overall momentum of the stock was down for quite some time coming through this zone here. And at some point, there was a fundamental shift in the way that the market viewed this ETF and it changed direction. So you can clearly see just by these lines how a market or stock can change its direction. We can apply another one coming up and see that again, the stock is changing direction. It was sideways temporarily short term, but now it's on its way again. So this is something that can ease your mind. If you're ever concerned about your stocks, you just put a trend line on the chart and you'll feel so much more comfortable about it because you'll know which side of the line it's on. How can I make it any more simple than that?
No, you can't. Yeah, that's awesome.
But that's with the right set of rules as well.
Yeah. Yes, that's right. Absolutely. Yeah. Just quickly on China, both your thoughts. I did a bit of research and did a podcast the other week about in Asia, there's a lot of countries, Taiwan, Thailand, Vietnam, where they're trading at really attractive PE ratios relative to history, 5-year, 3-year. China was one that was on that boat a year ago, and it's really taken off. Do you see the Asians as a good place moving forward? Can they outperform our market over the next couple of years?
Look, I think in terms of volatility, that's really highly probable. But I think if the Asian markets have this really good run, there's another run coming, then Australia is likely to be meeting that.
Awesome. Zoran?
Yeah. I think all the countries aside from China that you mentioned are considered as emerging economies within Asia. So I do see probably quite robust growth over the next few years. If you do understand the market appropriately, there's no harm in doing some sort of allocation of your portfolio within the sectors, particular sectors that are performing well. But that obviously comes with the caveat that you do understand the economy and the market that you're actually investing in.
Yeah, they seem to know how to do everything quicker and cheaper in China. But anyway, let's move on to the next one.
Me or you, Janine?
Oh, invest in global companies building the cryptocurrency ecosystem, including crypto exchanges, miners, infrastructure providers, and blockchain technology businesses, not directly in cryptocurrencies themselves. So again,
Shovel provider.
Yeah, that's what you talked about. You've talked about that on a few shows.
Yeah.
You know, look for the ones that are providing the shovel rather than the ones that are digging for gold, although gold's probably not the good example at the moment. But so if we just move the line up underneath that, we can see that at the moment that there's no issue with this ETF. It's just tracking that line nicely and holding its own. So, you know, I'm quite liking that. And this is a really good technique for anything, whether it's medium, long term that you're doing. Maybe you wanted to hold the ETFs to get some income out of it and you don't want to get whipped in and out and you don't mind a bit of that volatility. Because Phil's saying that, you know, okay, people think that they're getting into ETFs to avoid volatility, but are you really? And maybe it's just because you're not looking at it that often, but how often do you need to apply the trend line? Still, there's a 50% fall there.
Yeah, that's right.
It's quite volatile. So unless you go over the history of the stock and have a good look at it, and the ETF, there wasn't a lot of history to go by prior to that. And we can see that this is beginning a new phase of its movement right now, which is quite exciting, I think. So I would just keep watching it right now.
Yeah, that's the big sell in ETFs, promoted as not volatile, but it's not true. It really is not true. Maybe index ETFs have slighter, less volatility, but at the same time, if you're going to be trading strategically and then have a stop, it's all relative. Whether the up moves 10% and your stop's 2 versus the up moves 30 and your stop's 15,
That's right.
It's the same thing.
Yeah, exactly.
Yeah. All right, next one.
Cool. Okay, so the next one that we have is Global X S&P Biotech ETF. Invest in global healthcare innovators, including biotechnology, pharmaceuticals, medical devices, and healthcare technology companies. As you can probably tell, this one is, and this goes back to the point that Phil just mentioned previously, particular sectors obviously provide a lot more volatility than others. And this would be considered as a particular sector that actually does provide quite a bit of volatility as well, regardless whether you're trading the stock or whether you're actually trading the ETF. So, you know, this one is gone pretty parabolic at the moment. Obviously, there would be some news that are backing that trend. But like, I think all the ETFs that we've actually seen over the past 15, 20 minutes have a really, really good momentum that's actually backing them, regardless whether you're actually watching on monthly or whether you're watching on weekly chart. I think the key concept here, obviously, is to have a good set of rules, because when you get a parabolic move like here, you really want to make sure that you capture most of it, but also don't cut yourself short on the profit side because you actually triggered the stop loss or trailing stop loss too early. So I think that's an important aspect that we need to take into account here. Yeah,
I think AI's got a bit to play in the healthcare bios at the moment. But looking at that chart just quickly, do you think right now there's an opportunity, or where would you see this one going to next?
Yeah, I'd like to see a pullback on this. I'm not sure if we would be able to see as hard pullback as probably the breakout range when it happened out of this pattern, which was around $65. So ever since then, let's just have a look at the price percentage tool and see what sort of percentage it's actually done. So it's gone 21%, which is actually not too bad. So, I mean, if it came back within the mid-range and retraced somewhere probably 10% of the last major range that it's gone up, and it provided a solid entry, then it could give us a good buy opportunity. But at the moment, for my liking, and this is a textbook stuff that we've been taught within the course, you know, sideways consolidation in an upward market, you know, the smart money is coming in, the retail money is probably selling here, and then you get explosive move out of the range. And there's obviously different tools and you know, that we can utilize here to actually do the you know, projections how far it can go. But just looking at the chart broadly here for first time, I would like to see a probably 5 to 10% pullback, and then it might create a good opportunity. Volume is supporting the move, which is always good, which is always positive, but overall it's shot pretty hard. If you're on it, then it's a good buy. Obviously, you would have done so well.
Awesome. All right, well, stick around because we have more amazing ETFs coming up shortly. But now it is time for our trending topic this week, Janine.
Should investors be concerned about the latest Qantas flight credits class action, or is this a buying opportunity? Over 1 million Qantas customers have been notified of the $105 million settlement offered by Qantas without admission of wrongdoing. The Federal Court of Australia sent out notices advising that eligible customers need to register by 4 p.m. on the 2nd of October. Payments are expected later this calendar year. A $105 million settlement sounds enormous, but for a company generating more than $22 billion in annual revenue, it's less than half of 1% of sales. The bigger question for investors isn't the cost of the settlement, it's whether this action could change the long-term earnings outlook for Qantas. Also, markets tend to overreact to legal headlines, and once an announcement is made and legal costs have been factored in, the share price generally gets on with what it's going to do. But a settlement announcement does not always mean the financial risk is completely finished, and so customers have to wait for the federal court. From a charting perspective, we have a bird's eye view of the risks and the opportunity with Qantas shares, so why don't we take a look? All right, now on your screen there should be Qantas, and we can see there that the monthly chart on the left-hand side is showing how Qantas shares have had a decent pullback, which is good to see, and there would have been some opportunities in there to purchase Qantas at lower prices. So we'll just have a look at the degree of the fall. But it's important to bear in mind that, as I said, markets do factor in these what's known. It's only the perception or what's not known or of the fear that's generated around uncertainty that causes a lot of volatility. And once facts are known, then it makes it a hell of a lot easier for the big end of town to make an assessment, which it looks like someone's already voted because the share price is actually going up on this information. So as we said, $105 million doesn't seem like much for Qantas. But from a technical point of view, where do we expect Qantas shares could run? Well, we've seen over the long term that Qantas really spent a lot of time hanging around these levels. Now we can come across the chart here to look at why the mouse is playing up. But we can see here that there's a level there at around $7 where Qantas looks like it's, that's a very important marker for it. But the recent pullback should actually hold Qantas in good stead, I think. And I don't believe that this class action is going to actually stop the Qantas share price from continuing on. So what could cause a bit of volatility in Qantas's share price? We know oil prices actually will have a downside effect on the share price, and we've seen some volatility recently in that regard. But there's a really nice angle of this trend that's still holding, so it's really too early for anyone who was thinking about selling, if you're holding this more medium to long term, to do so, because it's still going up is basically the bottom line. Is there an opportunity to buy it? Well, if we go and have a look at the recent rise over the last 6 weeks or so, it's really been quite strong. There's a bit of resistance there at around $11. I'd be waiting for a pullback, see if it can hold support above $9.30 or thereabouts, and then look for the rise that happens after that, because it could be going to blue skies.
You know what? I find sometimes things like this are good news, because one thing markets hate is uncertainty. What's going to happen? How bad is it going to be? Is it going to be worse? How much are they going to pay? When it's all out in the open and you know what the result is, markets go, okay, well, 1% of revenue.
Oh, we've seen so many stocks where they've announced class actions and then the share price has gone up. So
because it's over.
Yeah, it really depends on what your strategy is too, whether you want to, go in that water. Because on the flip side to that coin, I remember, I think it was QBE. There were some really big class actions on QBE at one stage, and the share price went down. So.
Yeah, something to watch.
Yeah, it's you observe these things, and it's about doing your own research and letting the chart help you work out what occurs, I think, here.
Awesome. All right. Well, if you want the skills to analyse stocks just like you've seen tonight, visit our website, wealthwithin.com.au. But now let's get back to our topic and get into those ETFs. Zoran, what have you got?
So we've got BetaShare Climate Change Innovation ETF. Invests in global companies whose products help tackle climate change, including clean energy, electric vehicles, sustainable food, water efficiency, and pollution control. Yeah, I mean, Yes,
You don't
I
sound
don't want
too
to.
happy on this one.
I don't want to open the can of worms. I think we got other first world problems that we need to solve on Earth. But
What you want to talk about.
I will say one thing though. Again, just demonstrates once again, and I don't know whether picked all the ETFs on purpose or not, but like a lot of them are actually trending up quite well now, and they've actually got an amazing uptrend lines that are actually kind of holding on and hugging the trend. So this one actually does resonate with me quite well as well. So well done, Phil. If we have, if you do compare it to the rest of them, because it's actually found the bottom here, and if anything, this one is probably I would consider as an early buyer. Looking at the monthly charts. But on weekly chart, obviously, it paints a slightly different picture. Break above the high of 1150 could provide a great opportunity. Has broken out, broken outside of the sideways consolidation or the uptrend consolidation that's been going for quite some time. It's come back to test as opposed to the ETF that we looked at before. So that's a positive sign. We just needed to break above 1150 and then it could be a clear buy and hopefully continues heading higher.
Yeah, awesome. I think the nature of what you said before is very important in terms of the direction. A lot of them are pointing upwards.
Yeah.
And that's a point. Like when you're investing or trading, right now we're seeing that with the Magnificent Seven out in the US. Regardless of what's happening with the earnings, they are the place to go. Yep. All these new ETF products, you think if there's a pool of money, where's it all pouring into? It's all getting concentrated in the same place.
You got to follow the smart money, right? But at the same time, I'm a little bit of a contrarian where I prefer to get into ETFs or stocks that are actually looking like this on the chart because it's an early buys that get the most of the upside. So, I always say I don't care about the bottom 20% or picking the top 20%. I care about the middle 60%. So that's trading on confirmation as opposed to the speculation, right? So this is a particular ETF that you picked, which is really good because it does look like it's already taken off from the bottom up 20-30%. And that's fine because it's actually triggering another buy now and hopefully it can actually go towards the $14-15. And if that's my sweet spot that I'm going to profit from, I'm perfectly fine with that.
And the space is interesting. I know, you pause for a second, but like for me, the biggest thing, we're not trying to get political or ethical, but the biggest thing is the mandates haven't changed. There's still mandates out there to go to net zero.
Yeah.
And so ETFs like this still have the backing tailwind of possibility.
And you want to benefit from that.
Yeah, awesome. All right, next ETF.
All right, this one I like. You probably picked this one for me. It's called Food.
You like food?
Yeah, FOOD. BetaShares Global Agricultural Currency Hedged ETF and FOOD invests in the world's largest agriculture companies, including fertiliser producers, farm equipment manufacturers, seed companies and agricultural chemicals and businesses. And this is really interesting to me because I've been watching the wheat price, which has been at long-term lows, and now I'm looking at this. It's already broken out. It's come back to a line, but it's come back below where I expected that trend to stop, which is okay. Maybe it's just got to come back a bit further because it's a bit more volatile. And it was approaching that high, that all-time high. So now it's got to do the test and break through. But given the history of this, and the way that it consolidates for a while, there's nothing to tell me that it's going to do something different yet. So I'd just be watching it for the time being and waiting to see that consolidation and how it pans out. But I'd like to see it get back above the angle of that line first.
Awesome. Next one, Zoe.
So next one is called Fuel. Invest in world's largest integrated energy companies, including oil and gas producers such as Chevron, ExxonMobil and Shell. The portfolio is currency hedged into Australian dollars. I feel this one would be probably following through a lot with what's happening globally in terms of the crude and Brent oil. And that's why we're actually seeing shot up so aggressively and then coming down now, given the fact that obviously Middle East tensions have actually somewhat settled down and Strait of Hormuz has been open and ships are going through. So I think this one is not for faint-hearted, to be honest, purely on the basis that it's got a political, like heavy political play in it. And if you are trading this one, then you really want to make sure that you've got solid rules to actually protect you against any further downside, because whilst it can go up quite aggressively, and we have actually seen that, it can just as quickly actually come and fall out of bed, and you want to make sure you actually protect your portfolio. So when I look at in particular sectors or ETFs or stocks like this, I never put too much emphasis on putting a big portion of my portfolio in it.
Yeah.
I'd rather skew and reduce the risk and exposure. And if it goes in my favor, then hopefully I can capitalize and make up in the percentage profits.
Yeah, it's a good point. And I think that's one of the benefits of ETFs that's often spoken about, is that for the first time, I think ever, the retail space can now go global quite easily. I mean, by staying in an Australian account, still all the good regulation that you have with Australian trading accounts. And
not have to worry about the currency side of things.
Right.
Absolutely. And remember when we were like doing Wealth Within course, I mean, I don't know when you started, I started in 2010.
20 years ago, it's for me.
Yeah. Like you never, like investors or traders never had such an exposure to the global markets like we do now, right? Like the world has changed so much and there is so much opportunity out there. All you need to do really is actually gain the knowledge and understanding of the markets and basically, take full advantage of that. Yeah. Because we had an exposure to ASX 200 or 300. If you want to trade something more volatile, you're going to the speculative side of things, bottom end of top 300. And then if you want something blue chip, you look at top 50 or top 100. But outside of that, you would actually have to pay a hefty brokerage fee to go and get exposure out in the global markets. Now you don't.
Yeah, and that's the thing, right? You said it perfectly. If you know what you're doing, opportunity is your best friend. Before, okay, the opportunity by having, let's just say the 200 weren't performing or not getting much volatility. Back then you had to go out into outside the 500, which was a completely different market, much higher risk, less liquidity. Now you can go over the pond into Asia or into the US, equal like quality type opportunities, but more of them. I think there's, right now we're in the best times for opportunity.
I think so too. And markets are showing us that as well, because markets are performing so well, whether you look at domestic or global markets over the last year or two. You pick pretty much any sector, most of the sectors are actually trending up. Yeah. You look at, tech sector in the US, you look at the material sector, energy sector locally here as well. So there is actually so much opportunity and, hopefully the people that have done the course and, diploma, hopefully they're taking full advantage of that.
Yeah.
Because not many times you'll get such a bullish markets like we do now.
Altogether.
Because I don't care what anyone says, but it's a lot more challenging to trade choppy markets as opposed to one-directional markets which are actually trending up.
Yeah.
That's the time to make money and take full advantage of it.
Yeah, you heard it, mate. If you do want to get an intro, check this book out again. Now is the time, like Zoran said. Markets are flying. Your opportunity is now, and you don't want to bet on something 10, 15 years down the track and go, well, I should have learned the right way, and then be kicking yourself. So go and check that website out and look at the testimonials again, because they are showing amazing. You'll see what's possible. I'll just leave it at that. Janine, next one.
All right, the next one is GOAT. Van Eyck Morningstar International-wide Moat ETF GOAT. Very cute. Invest in companies considered best of breed across global industries, targeting market-leading businesses with strong competitive advantages rather than focusing on one sector. Now, this is where, don't fall in love with the idea of something, because
it's Warren Buffett
seen that. Mate. Yeah, we've seen that so many times where people have looked at something that's supposedly great and then it turns out not to be. Be the one that can actually choose whether or not to do it now. That's really the timing thing that's important. It's showing clearly that things have changed significantly for this one. So, it could turn around, but it could take forever. It may be that this is your best friend and tool for helping you determine which ETF you're going to pick, even more so than just whether you're going to buy and sell.
It might be coming back to that flatter option there, potentially, from the all-time low.
Yeah, it's trying to test that, these levels here potentially, but now it's about waiting and just leaving it go, because it's got plenty of resistance now overhead.
But that's good as well, because The momentum line that you actually put there, Janine, it just shows that he tried to climb back up. He tried to actually go above, but he just didn't have enough momentum and buyers in there. And obviously it's reversed and gone down now. And that's great as well, because he shows you that you should, if you have sold out, you should stay out of it now. If you haven't sold out, then you need to think of your strategy.
Yeah, and I think more than anything, when these kinds of ETFs are set up and they're promoted as the best of the breed companies, the stocks that are the greatest with the biggest moat, competitive advantage, stuff that Warren Buffett would really build his whole portfolio around, don't think that they're not immune from falls.
Yeah.
Don't think that a CSL situation can't happen just because you've got a stock that's got a moat. Or a cochlea. So that's the lesson in this. You need to be active and you need to be knowing how to get in and out.
Absolutely.
All right, next one.
So the next one that we have is called Global X Hydrogen ETF. Invest in companies involved in the hydrogen economy, including hydrogen production, fuel cells, electrolysis, storage, and infrastructure technologies. Yeah, this one is gone through shot through the roof, as we can tell, and it's actually about to test, or it's coming close to actually testing an all-time high, which was created back in November 2021. So it's done a massive V-shaped reversal on it. It is toppy on weekly chart, and it's looking like it could go further down. I would hope that it can actually, or expect to go around $9 mark. If you can hold here and reverse, then it could provide some opportunity to get back into it. But at the moment, I wouldn't see this as an opportunity to buy, to be honest. If you got an exposure in this particular ETF, then I would be probably holding on to it at the moment, because this momentum line is still actually fully functional. We can probably use the accelerated one, and that one would probably not be as good. But I think there is enough conjunction here for this ETF to come back and test these levels. If it does, then it could provide some good opportunities. But at the moment, if I'm holding on to it, I'd be probably looking to sell it. Depends on my strategy. If I don't have it, I wouldn't be buying it at this point in time, just because it's actually come back 10 or 15%, because it could have more downside to it.
And that volume there at the end.
And the volume is dropping off as well, yes, as the price is coming off too.
Interesting. All right, now before we move on, favourites, Janine.
Favourites, okay. I'd probably go the crypto one once it gets through that high there. We need to see a test of that bottom there. But outside of that, I think I was like Zoran. This one here, once you actually see it settle down and confirm that low, then once it gets back above that high again, there's plenty of upside in there.
Beautiful.
Yeah. I'll go with this one.
Yep. I thought you were going to say that. All right, excellent. Now moving on shortly, we're going to get into our hot stock tip. But first, let's answer your questions. Sumit writes, just wanted your opinion on Drone Shield. I currently don't own the stock, but I have observed that it can be good for short-term trading. It looks like it's reaching very interesting level, and was thinking about applying techniques on a daily chart to backtest and then enter the stock if rules allow. Now, this is interesting. I'm going to ask you, Janine. He's talking about short-term trading, the stock. Maybe a student, maybe not, I'm not sure. The fact that he says backtesting could be, but
yeah.
And it's a common question we get asked when we do the course. Does your course only allow for long-term investing? Can you short-term trade? Can you day trade? Can you trade FX?
And the answer is yes to all
everything.
of that.
Yeah.
But it's amazing how many people we've tested who have said, I want to test things on the daily chart, only to find out that they could have made more if they actually went on the weekly chart one time frame up, because you really do get sucked into things on that daily time frame. So that would be the first thing. The second thing would be, and thanks, Zoran, he's helping me. He's just getting excited about the chart. But the second thing is looking at the chart there and how the first thing to do is obviously answer that question. The second thing is to look at the bigger picture and say, well, what makes sense? Now, I mean, why would you even want to be looking at doing anything with this until you could confirm that that trend is changing, or early signs of that it's changing, which we haven't seen yet. So I think, one, I'll give you a tick for the stock that you've picked, because there could be a really good opportunity coming up. it's just too early at this point.
Way too early.
Yeah.
If it looks like a dog, smells like a dog, it's probably a dog.
Yeah, that's a nice analogy. But
And
Who
that's
told you that one?
Dale did. I remember it for
Years
15
ago.
years now.
But it's an because you see, I'm sure what you do at you know, a Blueberry, you see short-term trading, you see everything.
Mainly short-term trading, scalping, intraday trading, EA, expert advisor, automated trading. So whole heap of different range of like shorter-term trading. Yes.
Because you see a lot of people. That's the I guess the path they look to head down. But you said a very interesting thing in terms of don't forget the big picture, because that's going to tell you the real important message. Do you see a lot of people skip that in there, or they probably don't know how to understand the big picture?
Yeah. A lot of people get bogged down in the details, like too much in the details. And, you know, like when I keep talking to the high value clients or big traders, I generally tend to say like always scale back and start on a bigger picture, like whether it's for you daily or weekly chart, and then scaling down. And then you'll obviously bigger moves will create bigger direction, and they'll have more momentum, and then you can actually kind of scale back and do the analysis. But a lot of people actually do quite opposite. They start on a smaller picture and then, you know, they go on a bigger one. But like, look, there's no right or wrong. Like I keep telling people, there's absolutely not right or wrong. Like, you know, what you said, Janine, like, you know, medium to long-term portfolios are perfectly fine as well. And there's no harm in having both. I personally like volatility, and I like taking advantage of the market when there is actually quite a bit of movement going on. But again, it's not for everyone. It's not for faint-hearted. You've got to have quite a bit of experience to do that as well. So as a beginner, you know, you probably, it's hard to grasp that because emotionally it can actually drain you. But overall, there's no right or wrong. You know, constructing a medium to longer term portfolio and basically having the mindset where you don't watch things every day can obviously give you that work-life balance or whatever, and it can work in your favor. But then obviously if you like shorter term stuff, you can look at that as well. So it really comes down to you and your preferences, if I can say that way.
No, I said well. I think the best thing for you, Samit, is really, you know, sit down and have a look and make sure you're looking at all those lenses of the market, not just so bogged in on trying to get an opportunity or trade so short term that you forget to see the big picture. But good luck with all that. Now, Jamie is next. I am currently holding FEX. I purchased at 34 cents back in April as a long-term purchase. I was prepared for volatility and higher percentage losses. Gains, as I usually have one of these riskier stocks in my portfolio, around 5 to 8% of my portfolio. Okay, despite some okay fundamentals, the price has been dropping. What do you guys think technically about the stock? I am okay to hold for the support of around 21 cents. Or do you think if it drops below 25 cents, it's most likely going to head south anyway? And this is an interesting question because I find, for me, first, 8% of a portfolio on a specky is an interesting holding. I would say it's a bit bigger than not that big. What are your thoughts on that? And not, it seems like there's not really a focus on technicals at all. I'm not sure you're going to bring up the chart and see where he's bought and where it is now, but
I'm doing
What price
I'm trying
did
to
you
do
say
a
you bought
bit
it?
of analysis here.
so he's bought it at 37 cents. If we just go,
Okay, so he's bought on the when it's tried to break up.
in that little sidewaysy period through there. If we
Yeah,
zoom
just
up.
there.
Yeah, to your right.
Yeah, you know, I see where he's like. He's probably a little bit further up
Keep
here.
going. Yep. There we go.
so
37 through there.
when he was going sideways, maybe he thought this was actually the bottom here
In April.
in March, and then he bought in with the hope that it's going to actually break out the prior high and continue going up. But unfortunately, when you have a look at the all-time high that this stock actually reached back in October 2025, we're talking about 9 months of clear downtrend in play. Yeah.
And he's trying to fight against that. It's like
And he's
swimming
trying
against
to
the
fight
tide.
against the tide. And this is
But the fundamentals are okay.
so. But the interesting point is we've actually seen a stock just prior as well, and this one, and it's a similar mindset from both individuals. Like from what I'm gathering, they're both trying to pick the bottom on
FOMO.
both stocks and the FOMO to actually get in because they feel that, you know, in terms of value, it's actually looking cheap.
So what advice, would you give in this scenario? Because his question was, can it stop at 21 or can it continue to head south? For me, both things can happen, but you're going to be there sitting. If the worst case scenario happens, what are you going to do then?
First of all, I just need to have a look at what the loss is at the moment. So depending on what he bought, 37 or somewhere around there, I don't know what it was exactly, but okay, it's a 25% loss now. So, that's the first flag to me. It tells that there was no strategy there to manage. So I guess my first advice is make sure that you've got a proper exit strategy, and just having a line in the sand underneath the bottom of those lows when you're talking about the level of risk being what it would be, which is too much. You're willing to give away, just think about this for a minute, my friend, you're willing to give away 42% of your capital potentially, which could happen.
Of the 5% or 8%?
Of the 8% of your portfolio to people who are going to just take it. It's just a game of give and take here. And you're giving way too much away. That I couldn't say it any more clearly. I think in terms of where the buying opportunities were, can you see the difference between this sort of setup here? And I think that's the thing to look at. And that's what Zoran was saying before. People are not drilling back to the bigger time frames. It's what we drill home to people when we teach you to do this. And it's so valuable. It could have saved you that 25% and potentially more 25% if this is a strategy that you're following. But
could be 100%. I mean, it's not guaranteed that it's going to stop at 21.
Well, fall out of bed.
Yeah.
That's exactly what I was thinking. I do apologize for interrupting, because my question to the student is, how would you feel?
Well, he's not a student. Is he?
Well, student, trader, fan of wealth within.
It's not a student because there was no entry there.
Yeah. So how would you feel, and what are you going to do if this stock plummets through 20 cents and is basically takes out all this sideways range or accumulation during the period when it was actually going up, and it starts tanking downwards? Because I can assure you one thing: if it breaks 20 cents aggressively, it's probably going to get absolutely blasted. And in that instance, what is your exit strategy? Yeah. I think that's probably as simple and as clean as we can actually put it out there for this particular person.
All right, well, just some things to think about there. Hopefully the team's given you a bit of insight. I think the best thing you should do is go and look at trying to put some technicals in your trading, because it's going to help you a lot in terms of getting those entries right. But next is Alex, and he writes, I bought Telstra on a long-term move at $4.98. This recent weekly move looks a bit ominous, but still holding nicely above my exit at the moment. What do you guys think of Telstra long to medium term prospects? Janine?
Okay, I've got the monthly chart up there for you, Alex, and you can see that this really was a nice run that Telstra has. And how often does it do that? That's the question here, and that's part of the answer. Is it spends a lot of time going down and sideways versus going up. Now, this could be part of a continuation of a much bigger move. It's quite possible, but at the moment, it's right in the limbo zone. It's not a sell right now, and right now, if I know that the person's already holding it, but if people are out there looking at it, it's not a buy right now if you weren't already in it. So, in terms of managing it, this is where that book is so important. A simple trend line can give you that confidence to see that, it's holding above that angle of that trend at the moment. But I think the other thing to come back from that is important is that the question relates to that I don't have an exit strategy, which you never buy without having one. That is foremost, first and foremost when taking a position. So a couple of learning things there. At the moment, I don't dislike it.
Yep.
But, it could come down on the downside in the short term, and I'd be watching that very closely.
Awesome.
Can I just say something quickly? Yeah. I'm echoing the students' analysis, and I actually like Telstra. I think it's doing quite well, especially from the lows back in October 2020. This is kind of what I like to see in stocks when they move up and then consolidate for a long period of time before they actually go up and take the next leg. I think that's exactly what's happened here. I wouldn't be surprised, obviously, as you said, Janine, if this came back a little bit more. The key level that I'd be watching at is 448. And if it can actually kind of consolidate here, then it could potentially provide another entry. Break below these levels would mean that we are probably likely to go into the $3.80 to $4 range. And obviously, don't know your exit strategy, but it's probably likely that you'd be stopped out or you would actually exit by that time. But for me, key component here is the 450. As long as we can actually stay above that level, then hopefully it can actually gain momentum and continue heading higher. But I am a fan of Telstra. I think it's a good analysis and he's done a great job.
I think the key thing here, what you're both saying, is the exit strategy, because the worst thing you want to do in trading or investing is see a winning position turn into a losing position.
Absolutely.
And not have anything to do about it in terms of knowing how to protect the position, how to take as much profit off the table when you need to, when you leave it, all of these things that are so crucial and a situation you may be facing soon. But thank you very much for your email. Now time for our hot stock tip this week. Zoran, what have you got?
Yeah, the hot stock tip this week is CSL Limited, which has had an impressive recovery with the biotech giant on track for its strongest close since late April. The stock has rallied more than 25% over the past month after being heavily sold in May when it downgraded earnings guidance and announced significant non-cash impairments. Investors are now rotating back into the traditional defensive stocks like healthcare as momentum fades in banks and miners. That has helped lift the broader healthcare sector almost 90% over the past month. So let's now go and take a look at the chart. CSL, something that we've actually discussed for quite some time when I was on the show a few months or couple of months ago. Still not out of the woods. It's looking fairly bearish, probably in line with what we discussed earlier today in the show, and in particular for those actually students that actually pick those stocks that are downtrending. So whilst it has actually gone up and closed the gap, I'm not saying it's a buy opportunity. However, I do like the fact that it's actually come back aggressively. It's gone up around 19 to 20%. I think the healthcare sector, as mentioned previously, can help the momentum because there is a bit of a rotational play that's happening in the market at the moment, especially from the banks, which are grossly overvalued. So it's come back 40%. I wouldn't jump into it just yet, but the fact that the volume is actually supporting the move is potentially telling me that there is some smart money that's coming back into the stock. Ideally, I would like the CSL to consolidate around these levels for quite some time, probably come back to around the $110 mark and then provide another entry in with a tight stop loss. I would be maybe keen to do a small portion to buy in, and then hopefully as the stock is out of the woods and continues heading higher, I would be topping up my position for a medium to long term.